It's a really special show. We already got a lot of people joining our show. So if audio is good, if the sound quality is good, give us a thumbs up. Oh, we see Andrew in the chat, really excited. LFGO. Andrew, welcome, man. Love the hair. How you doing?
Hey guys, good. Thank you so much for coming, guys. We had a really good meetup in New York City. Thanks for a lot of people who showed up. It was a really hot day, very, very busy in Manhattan, but we had a really, really good day. Thanks so much, guys. We are excited to have a great guest, and we are really looking forward to have even better guests for our show. Thanks for coming. Thanks for your support. Give us a thumbs up, because this thumbs up helps the YouTube algos to bring our videos higher and higher for people. So we really appreciate coming and supporting us.
So one thing I learned, Andrew, in this meetup that was really interesting was I don't look my age. When I told people I'm 28 years old, everybody was super surprised. And the other feedback that I got is like everybody told me, Artie, we love when you talk about options, we just have no idea what you're talking about. So I think the learning for me is I have to tone it down a little bit. That's what I'm gonna do. And I've aged a lot. People didn't believe I'm 28, so that was definitely interesting. What was kind of your key takeaway from the New York trip?
The key takeaway for me was that people have a lot of suggestions on the education center and how we actually run the live chat room every morning. Mm-hmm. You know, someone mentioned that if you, Andrew, can actually tell us exactly how you see this trade and when you enter and exit it, you know, to explain it better. And it's good. It's a very good reminder for me, because sometimes I really, after so many years, I just do it, you know, very automatically and organically. But a lot of people who are new traders, they should hear what did I saw when I entered there. That's why the market replay that we have, the stock trading simulator, it's really good, because you can go and replay that and you can see the time and sells and order flow as well to get the better idea of trading. But yeah, so a lot of comments about how actually I can explain my trades better for traders.
Yeah, and I think you kind of do that in the recap, like you try to do it, but you know, like there's so many trades you've taken, so you get lost. But it's one of those things when you've been doing something you've been doing for like so long, you assume people know it already, yeah, and you forget to explain it.
That's a good reminder. Yeah. Whenever I see new traders, that's a very good reminder for me to do it, you know, more step by step. But it's also hard, you know, when I'm actually trading live, I have to look at my account, P&L, position sizing. There's so many things, plus making sure that I explain properly. So it's a little bit tough for me, but you know, I'll do my best.
Yeah. So a little bit about today's show. I want to give a little bit of. So of course we have our guest Michael Gayed. He's been a portfolio manager, risk on, risk off. He co-founded a company called Lead Lag Report, right, where he shares his ideas and his rule-based approach. I've used his research on a subscriber, so we're really excited to have him on. He'll join us in about 20 minutes, right at the market close. We'll probably have him about 45 minutes to an hour, so very excited. Of course, the support and success of today's show will be really helpful in kind of helping us bring even more high-quality guests moving forward. But the theme stays the same. So we're going to talk about market. Today was a brutal day. We'll talk about consumer data that came out. We'll talk about Nike earning, some of the risk in the market we're seeing. Talk about Andrew's trades. Of course, he didn't have a good day, unfortunately. And every time Andrew loses money, we get massive views on our YouTube channel. It's very interesting.
Yeah, I posted that. What is it that people love to see the losses? I mean, I guess it's probably a lot of education in there. People want to learn from the failures. I had a really bad day today. It just got chopped. I got a little bit greedy because I had a good opening range breakup on Tesla. Yeah. But I just keep trading that. You know, I wasn't happy with $1,000 day, and I just decided to just take more and more. So if you can look at my screen, I got this opening range breakup very easily and very nicely right at the open. I know Tesla is really down 5%, but I got this opening range breakup very nicely, but I just didn't partial enough. I didn't manage my size properly, and I eventually lost on that. This could have been a really good trade for me, but I personally didn't manage and trade it really well. So that was unfortunate.
Yeah, I traded Tesla today as well. You know, I got that bounce that if you were in your screen, I sold some puts. I thought we were gonna make a red to green move. Didn't like the candlestick and covered. You know, after we sold off. But it's definitely a challenging day. Today is a risk-off day for sure. One of the interesting days today, Andrew, I see in your screen, in your watch list, you got TLT on. So TLT, you know, the 10 to 20 year bond blend is up today on a day that equity is down. And Again, I personally think, and this is going to be one of the questions we're going to ask Michael, I think bonds are really oversold. And if with all this inventory buildup that we see in the balance sheet of companies like Target, Walmart, Nike just had earnings, this will lead into deflation. So people have to mark down aggressively. Deflation usually helps bonds, and we should see some kind of a rally in TLT. I've been burned on TLT before, but this is one of those things. You had the Nike chart. What a horrendous day for Nike.
Yeah, surprisingly, the Nike had a very, very solid opening range breakup. I totally missed Nike in my trading. I mean, after the market close yesterday, it popped up and then it sold off. And then at the open, it was really went all the way to the very, very solid from 108 all the way up to 114. I don't know what was that big squeeze, but after that, it just sold off. And right now, it's down 7%.
Yeah, it's funny. I mean, not to pick on Jim Cramer, but Jim Cramer was like, Nike's tone is really bullish. As soon as he said that, the stock's down 5-6%.
Legend Jim Cramer. I mean, it's hard really to predict anything, especially in this market. Probably what I assume is there were some sort of a mixed result on their earning. The inventory buildup that you said, this is very, very important.
Yeah.
You know, inflation. You know, everyone is concerned about inflation, and that has impacted the shopping habit of the people. You know, I personally don't have any financial problem, but I'm afraid to spend money.
I do.
You do. So, and that's the thing. And you know, these companies that they used to build up the inventory, and now they're seeing that people are not really spending as much, even though they might have money, but it's just that they're inflation worried. And this massive inventory build up, it kind of messes up their whole supply chain. Plus, the cost of trucking and probably delivery has gone up significantly. That's why the companies like Target, Walmart, and Nike are going to get hit. You think, I assume that in the inflation area, all of these costs is going to pass up to the customers, but it's not. They have to take a lot of hit, these corporations as well.
Yeah, exactly. Some of them, they usually call it, like, depending on where they are in the upstream and downstream. So the further you are to the upstream, meaning the closer you are to the customer, the harder it is to pass on those costs. So the suppliers have an easier time passing on those charges. The closer that you get to the upstream, it's going to be more difficult to pass on those charges. And speaking of deflation inventories, let's get into our slide deck. We got a packed show, really busy show, and I think these conversations will really get us ready for our guest Michael. This was the Nike's earning. Overall, a good earning, Andrew. You know, revenue was good, slightly down. So on a real adjusted basis, if you take out inflation, revenues were actually down. But a couple of things really got my attention, and I think people need to pay attention. This is why I'm shorting IWM, by the way. Look at gross margin, 45%. The expectation was 46.7. So about a 2% drop in gross margin. This is because of increased costs. And look at the inventory. Oh my goodness, talk about horrendous. Up 23% year over year. So this inventory has to get marked down at some point. And that means lower earnings. And if a company like Nike, being how big they are and how their supply chain is so intact and they have the best engineers, are having trouble with inventory management, I can only imagine the small caps, right? The IWM. They're probably the Q2 is gonna be very, very vital for them. So that's one of the things I'm looking at. That's one of the reasons I took that relative trade that I talked about in the chat. But of course, as we get more earnings, we'll get more information.
Yeah, so $1.2 billion extra inventory.
Yeah,
that's extra inventory that the Wall Street didn't expect, but they're actually having. That's very perfect. Excuse for a big markdown, and then prices might significantly coming down.
Yeah. So we have about 140 people joining us to the show. Well, thank you so much for joining. In about 15 minutes, we're going to have Michael Gayet, portfolio manager, join our show as a guest. We're going to talk about the crypto market, the housing market, the systematic risk in the market, a lot of stuff. So, give us a thumbs up, like the show, please. That would help the algorithm. More people actually pick up the show. Let's get to Cathie Wood, if we may. Cathie came on CNBC. And she said we are already in a recession. Again, she was very, very critical of the Fed, Andrew, and basically her thinking was, it's definitely surprising to see her on CNBC so many times, but she was saying basically Fed is making a policy mistake and we're already in a recession. And I think one of the really interesting questions was, Cathie, do you do you agree that maybe your fund is like fundamentally flawed or you've made any mistake? And her response was, the only mistake that we made was about our inflation call. Anything else, we didn't make any mistakes at all.
Yeah, it's really hard. I mean, there is no gurus, only business cycles,
Yeah.
and inflation has really tightened these business cycles. I mean, who would have thought after a great 2021 we got into a recession so fast? Usually these cycles are a little bit spread out,
7 years,
6 or 7 years, but the inflation has pushed this one into a cycle. Adi, I was watching, Jeremy Powell, the chairman of Federal Reserve, was at the Senate Banking Committee hearing last week.
Yeah.
And I was watching some of it. If you ask most of the American, regardless of their political way, who is the most, left liberal politician, is probably Senator Elizabeth Warren.
Or Bernie Sanders.
Or Bernie Sanders.
Exactly.
I mean, Elizabeth Warren is probably more to the left.
Yeah.
And she was concerned about the Fed's policy and pushing the economy into the recession. And she was, had a very heated exchange with Jay Powell that do not push the economy into the recession. And she was saying, yes, inflation is very important, but you don't want to kill the patient just because it's sick. If inflation is a disease that we have to cure, you don't want to shut down the economy into the recession. That means that it's very interesting. Even the most left politicians are concerned about the crashing the stock market and losing peoples and companies. So that was I couldn't believe that I hear those words from Senator Elizabeth Warren, who always believes that the greedy corporations on Wall Street are responsible for inequality and billionaires shouldn't exist. But that essentially shows how the stock market is relevant to the economy. Stock market is the economy. If you bring it down, if you smash it too much, it's gonna trickle down to all aspects of the economy.
Yeah, I mean it's such a double-edged sword, because in one hand you got a lot of wealth that is being wiped out through the stock market, and on the other hand you got rising rates, making it a lot harder for people to borrow. First-time home buyers, we know about the mortgage rate, but also there's inflation, and inflation is really hard on a lower income people, because they spend a majority of their salaries buying necessities like food and shelter, and the more you make, those become lesser and lesser part of your budget, so inflation doesn't impact you as much. But it's a lose-lose situation for the Fed. And our guest today, Michael Gayed, he's been one of the guys for at least a year and a half. He's been calling it a policy error. And it's one of those areas that I want to get into, and I want to talk to him of what really kind of stood out for him that made it a policy error.
So what error? It means that keeping the rates low?
Keeping the rates low for too long, and then being in a situation where they have to front load, right? So they have to be really aggressive because they weren't fast enough.
Yeah. So Paul said something interesting, that the former Fed Greenspan, he incrementally kept rising rates to create a soft landing, eventually crashed the economy. I mean, it's a little bit different. The financial crisis was a little bit different from here. That was a credit crisis. But this one is, you're really dealing with an inflation that is out of control, higher energy prices. So the situation is a little bit different from 2008. So it's really hard to compare these ones together. But what we are seeing right now is that inflation has to be under control, but at what cost? I mean, that's the big debate. Is it a big recession, a depression, or just a soft landing, hopefully? There's a lot of people who are still optimistic that they think that recession is overpriced already, and we might not get into that. I mean, that's a big question that everyone's going to see in the next 6 months.
Yeah, we were at the airport. We didn't see any signs of recession at the airport. That's for sure, right?
That's for sure. I mean, the flights. It's July and August. Obviously, is the peak of summer traveler. It was really, really, really busy, all airports. But again, a lot of these travels have been booked from the before, and it's not that people don't have money. I think there was a report that from a CEO of Bank of America that the average savings in America, and we're talking about the hundreds of millions of accounts, the average of savings actually higher. Yeah. But people are worried and concerned about the rising cost of living.
Yeah. Yeah, exactly. We got tons of people joining our show. Thank you so much for joining. In about 10 minutes, we're gonna have Michael join the show as well. Let's talk a little bit about consumer confidence. We just hit 16-month low. This is one of those leading indicators that I've talked about. If you go to my screen, there are two really good consumer sentiment. One of them is by the Michigan, and then one of them is by Conference Board, and we're at the lowest we've been, even lower than the financial crisis. So we're seeing vacation plans soften. It's probably due to higher airfares and gas prices. And about 30% of respondents expect business condition to worsen, even larger than 2009. So when you're looking at some of these leading indicators, it's already telling you. You don't have to be a rocket scientist. Just look at the market today, right? Every time we get a little bit of gas and want to aim higher, we continue to sell off. And today was another one of those days. Another thing was about these markdown in earnings, and this is from Morgan Stanley's Wealth Management Chief Investment Officer. This was a really interesting quote, and it says, economists have begun to cut down their top-down economic forecast for GDP, and yet fundamental company analysts are sitting there like deer in a headlight, not knowing what to do with the numbers. So he's basically saying the earnings have to come down, and if earnings come down, market has more room to drop. We know Morgan Stanley's target for S&P, by the way, is 330, 300. So for a SPY it would be 330, but for SPX is about 3,300. So that's their kind of price target. So they're extremely bearish. They believe we're going to see a lot of markdown in earnings. Analysts are too behind the curve. We're going to see markdown, and we're going to see continued sell-off.
I think what caught everyone, all the analysts and fundamental economists, was the persistency of inflation. Nobody was really thinking, that this inflation stays. And we're talking about a global inflation. It's not only only one country and one sector, and I think that changes the equation. Even the Feds were saying that it's transitory.
Yeah.
And now it's a dirty word. Nobody wants to use that, but really, I think it caught everyone off guard with that inflation, and that changes everything from the whole macroeconomic situation.
Yeah, we have about 200 people joining our show almost. Thank you so much for coming. In about 10 minutes, in about 8 minutes, we're going to have Michael joining our show. Michael Gayed, a portfolio manager, founder of Lead Lag Report. Let's go into our trading terminal, Andrew. What do you think? We covered a lot. Oh, one last thing we didn't cover. Robinhood being bought out by FTX.
Is it going to be bought out?
There are talks. Nobody knows. The stock obviously gapped up about 10-15%. I'm trying to do some research. Backman Fried, he's the founder of FTX. He was one of the first people who was doing triangular arbitrage in Bitcoin, buying Bitcoin in the U.S. market, selling it in the Japan market. So very complex stuff. He has a hedge fund background, and he's really interested in Robinhood. And when he was asked, he said it's a lot easier to go from brokerage firm to a crypto exchange than it is from a crypto exchange going back to a broker firm. Kind of talking on the impact of Coinbase, right? Like Coinbase is going to have a lot of difficulty getting those requirements, dealing with SEC to go from kind of an exchange for crypto to brokerage, whereas Robinhood is a lot easier on the other way around. I'm still doing more research on the legal aspects of it, but I thought it's interesting that Bankman Fried is interested in Robinhood. I mean, they got 28 million users. Yes, granted, they're not very wealthy users. The account size are only like a few $1,000s, but still users are users.
Yeah, 100%. So I didn't get that. So the deal is going through, or it's just a proposal?
So he already owns 7% of Robinhood. So he's already bought 7%, and there's rumors of the buyout.
Full takeover.
Full takeover. So of course it all depends on how it is. Is it going to be more than 50%? Is Robinhood going to stay public? Is it going to take it private? It all depends, right?
Yeah. Excellent. Well, that's great. So looking at the markets, we're down heavily on Qs 3%, SPY 2%, IWM 1.7%, which surprisingly is holding better than SPY and QQQ. Dow Jones 1.5%. Bitcoin again back into the low 20,000, and we're going to see that. Another question that Adi, we want to look into that was that does Bitcoin or cryptocurrency has a systematic risk to the financial market?
Yeah.
And if it collapses, is it going to bring a lot of things with them down or not?
Yeah.
And that's something that I think you should ask Michael, because he has been a big, how do I say, the people who are really judging cryptocurrency narrative. And if
he's been really harsh on
very, very harsh.
Yeah. I mean, I guess the correct way of saying it, he's been really harsh on the false narratives.
Exactly.
On
He's the critic of the false narrative,
Yeah.
not the technology or the potential itself. It's just that, all those crypto bros that they think this is the solution to everything. So where is it? Show me.
Yeah, exactly. I mean, I am currently at our trading terminal. It's a tool we're building for our traders. SPY down, majority of the indices down. Lumber had a solid day, but it's still a lot lower than its previous highs, only at 585. Gold is down on another, I guess, on an expectation that inflation has peaked, but that's yet to be seen. On a sector. Looking at the sectors, energy again the strongest. We just recently this month had a 25% drawdown in energy, by the way, and of course you got your utilities holding a little bit more, so more defensive, and consumer discretionary of course having a really rough time, being the lagger today.
Energy has been the very strong sector.
That's,
looking at normalized market performance, as you see, as of year to date, we're talking about Qs down 30%, IWM 23%, SPY 20%, and Dow Jones 15%.
Yeah. Well, thank you so much for everybody tuning in. We have over 200 people joining our show. We really appreciate it. Let's go to our earnings season. Andrew, any specific earnings that you're kind of looking at? PayX is interesting. Tomorrow.
I think Micron is on Thursday. It's interesting to see that.
Yeah, Micron. Yeah, definitely. This is going to be interesting, especially with this lack of demand for the chips. We know chips prices have come down tremendously, so that's going to be really interesting as well. And then next week we got a few names, but I think kind of mid-July is where the earnings really start taking off, and you got your banks. Morgan Stanley, JP Morgan, BlackRock, your private equity funds, asset management. So it's going to be very interesting earnings season this time around.
I mean, the earnings season, when does it start officially? I think it starts in 2 weeks.
I think it's starting right now. Each company has different schedule and different fiscal year, but the Q2, majority of the Q2 names are going to start within the next 2 weeks. So July 15 is when the bank usually starts, and bank really started off, and they go off. Of course, you really want to look at banks' earnings. You want to look at loan generation. Are they still generating enough loan? You want to look at loan loss reserves, and how is that changing? So the probability of default, that really gives you a really bright lens into what's happening in the market in terms of the recession talks that we've been hearing. So you definitely want to pay attention to the bank's earning if you're a position trader, even if you're a day trader. So that's one of those earnings that I'm monitoring really closely as well.
Yeah, excellent.
Yeah, thank you, Carlos. Carlos is in the chat. Rikin just joined us. Hello. Yeah, welcome. So in about 2 minutes, we're going to have Michael joining our show. Michael's a portfolio manager, founder of Lead Lag Report, and someone who we've been following. Both Andrew and I have been following, and we're really excited to have him on the show, definitely.
Yeah, thank you so much, Leo, for giving us a thumbs up. So the Lead Lag Report, go to leadlagreport.com. Actually, I show it in my screen right now. That's a website that belongs to Michael, and he's published weekly newsletter, weekly risk on risk us. There's a lot of very good market analysis and risk assessments, and high yield investment strategies are in there. And actually, Adi, I think you're a member, and Adi's
I use some of Michael's research for the fund we're managing, right? So I want to kind of get a sentiment. I'm a huge fan of his research and his work, and that's one of the reasons I was so keen to have him on the show today.
Yeah, make sure to check it out. I'll just send a link over there for people who are interested to go and check it out. And making sure that I think there is also a free trial or a very discounted trial that if you want to go. So I think it's worth really going in there.
Yeah.
And Michael is a great speaker. He's really very clear and is you're gonna enjoy the show, I'm sure.
Yeah, he's probably one of the hardest working people I know, because from all the spaces, Twitter spaces that he runs, all the way to the fund that he managed and all of that stuff. I don't know, he's probably working 14, 16 hours every day, so very excited. Of course, the show is live, and one of the reasons we wanted to keep it live is we want to have a really interactive show. So, if you have any questions, feel free to use the chat, ask them, and then if the time allows us, with Michael, we're going to ask Michael those questions as well, and let him know. About 1 minute to close, looking at our trading terminal. Another massacre day, man, and that's the closing bell.
Yeah, excellent. So the market closed SPY 2%, Q's a little bit over 3%, IWM almost 2%, and Dow Jones 1.6%, and Bitcoin is just hovering around $20,000. So a little bit of a risk-off day, and I'll see how it goes. Although we had a very strong week last week, well, let's see if this is just a pullback or starting another leg down. I think we should have, it's 1 p.m., I think we should have right now
Michael joining us really soon.
Very soon.
Jared is saying SPY barely holding on to the Malos. Yeah, exactly. On a technical level, SPY is definitely weak. You know me, Jared. I'm more of a macro guy, looking at the macro picture, and I was kind of expecting that. So it would be interesting. I'm short IWM, so I wanted to go lower, of course. But let's see how that goes.
Are you short through options, or you have TZA?
No, I'm short IWM, and I used the money I got from my brokerage firm and opened a position in VYM. So it's a Vanguard ETF, value oriented. So it's a relative play solely based on what I believe, over the next 3 months, where the strength is going to be. I think value is going to hold up better than small caps, which is more cyclical. But let's see. I might be wrong. I'm going to ask. I'm going to ask Michael's opinion on this trade too, maybe.
Yeah. So we're waiting. We're waiting for Michael to join us, and until he comes, we can take a look at the IWM weekly. Its IWM on a weekly chart is essentially touching the highs of the pre-pandemic. It's holding really around that area. So SPY is far from the high of pre-pandemic. The Q's same as well. They're high from their pre-pandemic. So
is that the 200 moving average over there on the weekly?
On the weekly chart, is 200 moving average down there, but they haven't touched it yet. Let's see SPY. IWM, I think, broke down already that 200 moving average.
Yeah, that's going to be very interesting. Very, very, very interesting. It's all about how much damage can the Fed do, really, and that's what's being priced in right now with the recession talk and this aggressive rate hike. Okay, our producer is giving me the thumbs up. I believe Michael's on the show. Michael, welcome to the show. How are you?
I apologize for the delay. It's been one of those days.
Oh, I can imagine. No, I was preparing for the show and I got a notification that you're running a Spaces. I'm like, Michael never stops working. He's always on and off, creating content, adding value. Well, thank you so much for giving us the time.
Well, I appreciate it. I don't know if I'm adding value or making it maybe not adding value. It depends on the environment, which we'll talk about.
Yeah, exactly.
Thank you so much. It's a pleasure and honor meeting you, Michael. Again, thank you so much for your time. Right now, we have over 250 people on live, and hopefully more people joining us. And I'm excited. I'm a big fan of not only the content that you're publishing, also the humor that is in your Twitter. I really love that.
Definitely. Michael, just kind of getting us started, again, majority of our members and our followers really know you and are familiar with your Spaces, but can you just give us a quick background, introduce yourself? Of course, we've done that extensively today as well, but it's always great coming from you.
Yeah, no, I appreciate it. So my name is Michael Guyad, publisher of the Lead Lag Report, portfolio manager of the ATAC Fund family, put out quite a bit of research content, better part of the last decade, tried to build a bit of a name in the industry, had a phase in my life when I was on CNBC and Bloomberg almost every other day. By the way, please don't close the browser because of that. Was one of MarketWatch.com's top writers, and built a fairly large social media following. As you guys noted, I've got around 650,000 Twitter followers, 30,000 LinkedIn. First connections, I always make this point that I am no better than anybody else in the sense that We're all trying to deal with the unknowable future. We're all dealing with short-term and long-term dynamics. We're all dealing with drawdowns, maybe at different times, maybe at the same time. But I'm certainly happy to have a discussion with you guys here.
Yeah, definitely very excited. As I mentioned, I'm actually a subscriber to your lead lag report. I've promoted in the community before. We get a lot of value in the fund that we manage, and the lumber to gold ratio, the risk on, risk off. Kind of talking about your RORO ETF and your risk on, risk off. I want to spend a little bit of time. I'm a huge sports, a basketball nerd, and in basketball we say defense wins championship. And when I look at your fund, the strategy, switching to treasuries and then switching back using a little bit of leverage, it feels to me it's all about playing defense the right way. So can you tell us a little bit about your talk, like your fund and your rule-based approach?
Yeah, well, the thing about defense winning championships is that that's not always the case. That's on average, right?
That's true.
And this is kind of this is one of those things which is I'm sure those that are listening may be looking at that ticker RORO
Yeah.
and say, what the hell are you guys talking about being risk on, risk off when that ETF has had such a nasty drawdown? Now, by the way, all three of my funds, my mutual fund ATAX, the RORO ETF, JoJo, Junk on, Junk off, they're all variations of risk on, risk off, but they've all candidly not really fared that well at all this year because even though defense wins championships, what do you do when your brakes are not working?
Yeah,
And when
exactly.
you're driving, you're in a storm, right? So the premise around everything that I do is that one, there are certain leading indicators to high volatility moments for equities, and two, which is just as important, is that treasuries are the way to play that high volatility in equities. So you talk about lumber to gold. The idea there is that when lumber is outperforming gold, generally that's a risk-on environment. Historically, when lumber is doing better than gold, stock market volatility on average is lower. Why is that? Because lumber is a play on housing. So the average home has about 16,000 board feet of lumber. So as lumber does well, it suggests housing is doing well. If housing is doing well, it suggests risk on, right? At least for a moment in time. And historically, it's not my opinion, annualized average volatility for the S&P when lumber is doing better than gold tends to be lower than when gold is outperforming lumber. Now, usually when lumber is weak relative to gold, that tends to precede major crashes, corrections, and bear markets. So on the one hand, you can argue that that signal this year got it quote unquote right. But what are you supposed to do when your expression of risk off is treasuries, which it is in the case of all my funds, ATAX, RORO, JoJo? Well, that's a problem in a year like this year, which is unequivocally an anomaly
Yeah.
because treasuries have had, in some cases, a bigger drawdown than equities, meaning the correlation of the decline of stocks to bonds is unbelievable here. All right, what are you supposed to do when risk off is acting risk on? And this is an important point for active traders, which is to say that people focus too much on the signal. The opportunity set can be just as important in that moment in time. Now, you can argue that treasuries as a risk-off safe haven are broken, except on a day like today, where clearly they're rallying, or they rallied, they did well while the S&P is down. That's convexity, that's risk-off. What we saw today was, let's call it more classic risk-off, right, with treasuries rallying and stocks down. You can say that treasuries are broken because of high inflation. Okay, they're broken until they're not, right? And that's why I go back to how I started the conversation. We're all trying to figure out the unknowable future. We're all trying to manage drawdowns. And even though you could be risk on, risk off, that doesn't mean that you don't have risk, because you could be in an environment where risk off has a lot of risk, like we're seeing this year.
Yeah. I mean, I try to catch the bottom on TLT. Looking at some of the inventory data, thinking deflation is coming, so bonds should rally. And oh boy, I was wrong. I got burned. So it's been a really tough trading year for everybody because things are really.
And I remember that Michael has been warning that this market is hell and it's very difficult to trade on that. I've been following you for the last 6 months. You've been warning us for at least for a few months now.
Yeah. Kind of
And the thing is, and real quick on that, I couldn't do anything about that, right? So I've got these. I've had people say to me, so you've got the three funds. It's your fault that your strategy is down. First of all, they're rules based. It's not based on my opinion. I'm a cheerleader to my own strategy. Right? I created the intellectual property. I launched the funds. I put a lot of my own capital to launching the funds. I happen to launch the funds in a historic environment for what the funds do, because again, it's not my opinion. You look at treasuries and equities. Even in the 70s, you did not have this kind of a drawdown, this kind of correlation. So that hell is the idea that everything's acting the same. Now you can say, well, commodities are different. Okay, except this month, right? The way commodities have very suddenly now done an about face.
Yeah.
So you have to be very careful, which we'll talk about as a trader and as an investor, in abandoning an approach because you're in the small sample where the approach is not working. Just because you are going through some kind of drawdown, some kind of dislocation, doesn't mean that because it didn't work on the single roll of the die, you should stop rolling.
Yeah, very well said. Yeah, exactly.
Yeah, Michael, I have this is a very interesting thing. I think this just came out of my mind that, you mentioned about the approach and the fundamentals in your trading and investing. Like I know ARC innovation, it's all based on innovation and the future in the 5 years cash flow. What happens to these funds that they're fundamentally based on the future growth and disruption? What happens to those funds in this environment then? Or they really go bankrupt?
I mean, I'll tell you if it happens, if they're going to go bankrupt, right? I mean, that's everything's easy with hindsight.
Yeah.
Look, let's talk about that because it's a lot of people say the market. The market is not the S&P. The market's not 500 stocks. Yeah. The market's not 5 stocks, which is what's driven the S&P, the FANG names, right? Yeah. The market is everything. Okay, so when you look at it from the perspective of breadth, okay, and this will relate to ARC and other types of innovation type of stocks. The reality is this has been a horrendous bear market for well over a year.
Yeah.
Because you look at the vast majority of stocks, the drawdowns are unbelievable. As of last week or the week before, the percentage of stocks in the NASDAQ composite trading above their respective 200-day moving average was 9%.
Yeah.
Right?
Really?
The vast majority of the market has been in a bear market.
Yeah.
Right? So and that makes it really good. And by the way, the not just a bear market, but like a nasty bear market. ARC is sort of the poster child for that. But does that mean that these companies will no longer exist? I have no idea. All I know is that you're already number one long in the tooth in terms of this decline. So I would argue you're probably due for some kind of reflex melt up rally just to surprise people because the sentiment is so bearish. But having said that, this is the challenge. As I always say, markets crash from oversold levels. So you have this dilemma as a trader, right? Do you bet on the crash after this has already persisted for so long and after sentiment is already so dark? Or do you bet against the crowd for a moment in time because nobody seems to think that you could have positive catalysts? I don't know the right answer, right? From a rules-based perspective, I'm simply tracking what Lumber to Gold is saying, which is still saying risk off. Tracking what utilities are saying, which are saying risk on. So even my own funds have a disconnect in terms of positioning. But that's why this is so difficult. It is not easy to make a directional bet either way here because the length of time the weakness has persisted is well over a year. And at the same time, you can easily envision a scenario where the S&P goes round trip back to the COVID lows, just like a lot of stocks already did.
Yeah, exactly. I want to kind of add, continue that conversation is you have a really, really nice saying. You say, opportunity arise when the crowd thinks they know the unknowable future. And kind of on that basis, do you think the kind of the recession talk is a little overblown? The recession trade, like I was looking at the consumer sentiment, like the lowest it's been, so bearish. And you talk about that melt up. Do you think there is an opportunity maybe for rip your face off rally in this market right now?
Well, look, I mean, first of all, and the other line I keep saying is that bear markets make fools of bulls and bears, right? Because in bear markets, you have these 15, 20, 25% rallies. People forget that after the 1929 crash, the Dow rose 30% in 1930 before ultimately making lower lows during the Great Depression. So my point is that, why do I always say that it's not about prediction, it's about path, it's about the way that things play out. Because it could very well be that you end up having everybody right about the bear case, but not necessarily right tomorrow or into the end of the year, right? And that's the challenge from a risk management perspective, right? Because yes, you're right. Everyone is saying recession. It's now in the headlines. You've got Cardi B talking about inflation, for God's sake. It's now in the popular. And by the way, you got to always be careful when pop stars will talk about economic terms, okay, or talk about investments like the laser eye community with Bitcoin. Okay, when you started seeing all these athletes, it's like I was joking on Twitter on the lag report. Paris Hilton, put her laser eyes on her profile pretty much at the top of
That
Bitcoin.
was the top. Yep.
Right. So, and I only use that not to pick on Paris Hilton or not to pick on celebrities, but it's like you got to be careful when things are so popularized because if it's that obvious and that known, how can you make money off of it?
Exactly, because alpha is limited, right? It will disappear. That's the number one rule in finance, and mean reversion is one of the things you say. We will revert back to the mean. So, since we started talking
Well, the
about
question is where
crypto,
that mean is. Right. Right. The question
yeah,
is where that mean is. That's the challenge. Right.
that's definitely a challenge. Andrew, do you want to take it to the crypto since we
Yeah,
already
I would
talked
love
about?
to. So I know you're one of the biggest critics of cryptocurrency narrative, and then how they want to sell the idea of the blockchain. Can you comment on that? And also, I have a question for you. By the collapse of crypto the way that it is, do you think there's a systematic risk to the financial system that if these exchanges all go belly up, then we're going to have a really big financial crisis like we had in 2009?
All right. So a few things. So first of all, I'm glad you specified I'm not a critic of cryptocurrencies and Bitcoin. I'm a critic of narratives. I'm a
Yep.
critic of narratives in everything. I'm a critic of narratives when it comes to Tesla. I'm a critic of narratives when it comes to Bitcoin, when it comes to even energy. Okay. I
Yeah.
mean, everything. Look, I get it, right? People need stories. They need reasons for why. They need the qualitative explanation. But the reality is, the narrative always follows price. And when you get to a point where people make their identity about an investment, that is usually a really negative sign because that means that people are so convinced that they know the unknowable future that it makes more sense to bet against it. Okay.
Yeah.
So, from that perspective, yes, cryptocurrencies have a narrative problem. You've had a pretty big decline. You've had a deleveraging in the space, and you're right, you still have ongoing issues as far as these exchanges. Do I believe in Bitcoin longer term? I believe it's possible that Bitcoin does eat the world. I also believe it's possible it doesn't. Again, I don't know. Nobody knows the
Exactly.
future, right? And that all that means is that you can't have too much of a high weighting in the space. Now, I do believe that there is a hell of a lot of fraud and a hell of a lot of bullshit, right? As much as people will argue, correctly so, that this is a Ponzi scheme with the U.S. dollar, with interest rates, with the federal government. I'm down with all that. Okay. The problem with the cryptocurrency space is that even though you can argue you can keep on printing dollars to support the Ponzi scheme, you can also keep on creating an unlimited number of cryptocurrencies based on a variation of code,
Yeah.
which creates a Ponzi-like element to the entire asset class in the entire space. This is why the SEC has been so hesitant to actually approve a Bitcoin ETF. Because what does that mean for other cryptocurrencies, right? That you can just kind of literally code, and it's like what Dogecoin was created in how many minutes, right? The code for that. So from that perspective, I think it's good to be skeptical. Now, on the systemic risk point, possibly, a further collapse and crash in Bitcoin in the cryptocurrency space, yes, can have an implication on equities. Now, that sounds silly. It's like, how could a relatively small asset class against the magnitude of equities, the magnitude of bonds, how could that break equities and bonds? Well, because it's about leverage, right? If
Yeah.
it's about a deleveraging in the cryptocurrency space because of massive excess leverage because there's no regulation, sure, you could have that filter through to other asset classes because it's all one trade.
Yeah.
Yeah, that's a very interesting point.
It can happen with a lag, right? That's important too. It can happen with a
Yeah.
lag.
Yeah, thank you. And you said something that I remember you recently posted that when an investment becomes a religion, then it's very, very dangerous. And that's what you exactly
Yeah,
said.
you
That
gotta be careful.
crypto has become religion for a lot of people.
I was looking.
Yeah, and this is really the thing. It's like this is why I use that line because again, it's like if you want to stay in the game, you have to be humble. To be humble, you can't have too much faith in any particular outcome because that's what makes you weight in a portfolio less. The funny thing about all the people that are misunderstanding my view on cryptocurrencies is that they think that I'm kicking them when they're down when I make fun of the store value line, which clearly I was right on, or the inflation hedge, which clearly I was right on. I'm not kicking cryptocurrency investors when they're down. The best thing to do is to properly characterize it. That
Exactly.
maxis, instead of being so aggressive in their belief, actually say to people, you know what, this is probably going to be a good place to be, but weight it properly. Because that's the only way you end up having people not over leverage in the space, which is what causes the crash, which is what delays the inevitable institutional adoption. So, I'm a very much a believer that you have to frame things properly. Now, again, I'm talking from the standpoint of somebody who's running funds that are risk on, risk off, and risk off hasn't worked. And I'm not out there saying risk off doesn't have risk. Why is it termed risk-off treasuries? Because in classic finance, treasuries are the risk-free rate.
Yeah.
It's the RF, right? I mean, it's categorized properly. And why is it risk-free? Because there's no default risk, because the U.S. government can print dollars to pay off liabilities, right? That's why it's risk-off. But that doesn't mean there isn't risk in price movement. And I've been very open in saying that. So characterizing something is the number one rule, right? For anybody or any group that wants to change the world based on whatever they're investing in, whether it's EVs, Bitcoin, or anything else.
Yeah, exactly. Speaking of leverage, and you were talking about leverage, I was looking at some data yesterday, and I was surprised. There's still a lot of inflows to these leveraged ETF, like the TQQs. Like, are we like Nasdaq being down already almost 30%? Are you as surprised as I am with still the amount of speculation going on in the market?
Partially. I mean, this is why I don't believe the low is necessarily in, even though I think you could have a reverse rally before ultimately lower lows. When you're in a world where there's basically zero commissions to trade,
yeah,
and you've got message boards, and you've got a lot of people having so much easy access to markets, you can't ever fully get rid of the speculation. You can lessen it, right? Yeah. But those people that are ultra long could end up being right? I mean, I think that's very possible. That's why I've been saying there is a legitimate melt-up scenario. But if I'm wrong, okay. I mean, it doesn't even matter for my funds, right? Whatever I think, because it's rules-based. I'm looking at the indicators, saying the indicators look like they could be all saying the same thing in terms of risk on, but who cares what I think? It's about the triggers. When you're systematic or rules-based, it doesn't matter. I think it makes more sense if you're going to use leverage, to go leverage long than leverage short. Yeah. Because leveraging when you're short is really where it gets to be very dangerous, especially with these daily resets on some of these leveraged funds, right? I always use this analogy that in 2008, the 3x long financials ETF, FAS, and the 3x short financials ETF, FAZ, one's long, one's short, inverse. Yeah. There was a point in 2008 they were both down 70%.
Yeah.
Right? Even though the direction was down, you would think you'd make money on shorting because of the sequence of returns that inverse daily reset killed you with leverage. So I think if you're going to leverage, it makes more sense to go levered long, but also be careful, because leverage is how you have ruin.
Yeah, awesome. Michael, first of all, we get a lot of positive comments right now that they love your comments. Thank you so much again for coming. I have a question about the Fed's policy in the pandemic and compare it to 2008, 2009. They had this quantitative easing and zero interest rates, but we didn't see that inflation that time. What happened here that even before Europe war, we had this inflation? So a lot of people might say it was because of the energy prices, but we had the inflation even during 2021. What has changed? Why this policy didn't work after pandemic, and we are seeing this inflation persistently?
Well, it's interesting. It's about perspective, right? So I would argue that you had inflation. It's just it was in the financial markets. It just wasn't in real goods, right? And you can see that with PE expansions. You can look at price to book. Price to book never once came anywhere close to how much PE expansion explained price movement, right? Post great financial crisis. Look, there's this old saying that nothing matters until it matters, and then when it matters, it's the only thing that matters. To your point, money printing seemingly didn't matter for a long time because you didn't have inflation in goods and services, you just had in financial markets. Well, but now suddenly it matters, right? So I think you have to be careful about trying to say, why is this time different? It may never have been different. It just may have been a situation where it just needed some kind of nudge for that inflation to actually persist. Look, the reality is what we're seeing today is a function of not just the commodity push side, but it is the demand side. There is a stupid amount of money that has been thrown at this post-COVID. We know that, okay? And the Fed took actions that I would argue were actually needed in the very beginning, but the problem is they didn't pull it back fast enough. And back in June, I tweeted out saying the most responsible thing for the Fed to do was to raise rates unexpectedly. Why was I saying that in June of last year? Because you didn't need to see economic data to see how all this liquidity was causing rocket ship emojis, was causing it was causing memes and the uneducated speculation I ranted on, which, by the way, hurt my own funds because of the impact of what the result was, which is that equities and treasuries both collapsed this year, right? Even though I know what my funds and the strategies and the back is, I know how they perform. That's why I'm so committed to them, right? But it was so obvious with hindsight. All you need to do is look at the sentiment on Twitter to see that you had to pull back liquidity yesterday.
Yeah.
So, now, do I believe that inflation is secular long term? Personally, I don't. I tend to be more of a deflationist. I tend to believe that people seemingly forgot that it's very hard to have sticky inflation when you got $30 trillion of U.S. government debt, and never mind the $170 trillion of unfunded liabilities. The more rates keep rising, all right, the more that interest expense eats away at actual earnings of companies and, by the way, of GDP. Okay, so I look at all that. I say to myself, the funny thing about all this transitory talk when it came to inflation is that the Fed never defined how long transitory was. Transitory can be 3 years. That sounds like a lifetime for people. But you think about cycles that can be hundreds of years. It's nothing.
Yeah, exactly.
Well, thank you for that. Adi, you want to ask the
I
next
got to follow up on that. We're talking about inflation, and of course we had Walmart, Target, massive inventories. I was looking at Nike's earning inventory up 20%, and of course Dr. Berry also tweeted. Every time he tweets, it's a financial news about a deflationary bust, and this is something you've been speaking about. It's inflation. The key is the speed, and the speed was so high on that inflation that the deflation is much more likely. You're still holding that view, and how are you kind of digesting all this information in the earnings that are coming out with this inventory buildup?
Well, I mean, that's kind of what's happening now, right? Because recession risk is on everybody's mind. Well, recession is deflationary or disinflationary.
Yeah.
Right. It's like that's what's missed about this. So look at what's happening. You're already seeing layoffs in the financial sector. Right? You're starting to see at the periphery some layoffs in other industries.
Yeah.
I'm pretty sure that's what you see in disinflation, deflation, in recessions. Right. So it is always about speed because it's about the ability to pass it on to the consumer. Right. So if it's too quick, what happens to profit margins? You don't have enough time as a company to pass that on, for the most part, and consumers don't have enough time to actually start changing behavior on that. So it becomes a shock.
Yeah.
Right. So again, I've used that line. Inflation shocks tend to be deflationary. It would not surprise me if suddenly by the end of the year we're back into a mode of, well, maybe we can't really do quantitative tightening. Maybe we should think about lowering rates. Maybe we overreacted. Right? Because if you think about what the Fed's really trying to do, they're trying to buy time. They're trying to buy time to make sure the supply chain issues are resolved while not having a situation where all the money they printed creates, milk costing $300 a gallon.
Yeah.
Right? I mean, believe me, if milk's at $300 a gallon, you better fucking believe that's deflationary.
Exactly.
I stopped drinking milk, that's for sure.
It's speaking of this deflation and the Fed really lowering the rates. I was looking at copper to gold and 10-year and the divergence there, and it's kind of saying the bond market is basically calling the bluff of the Fed and telling them you can't. Your Fed plot that you're giving us, it's really useless. There's no way you can be as aggressive. What are your thoughts on that?
No, I think you're spot on. You're seeing that with a lot of commodities, right?
Yeah.
And with especially the way things kind of played out. And again, I'm down with the secular argument of commodities, but for all this talk about oil and commodities and that they tend to spike in advance of recessions, somehow people forgot that what happens to those areas during the recession? They collapse,
Exactly.
right? So it's like again, I don't. There's a degree of sort of lack of asking Socratic method, right? Keep asking questions to get to the right answer. Right, which is what I try and do in the way that I approach looking at markets. So, all that's sending the same message out, right? That there's a disinflation, deflation pulse. Now, initially, and this is why I'm saying I think there's a setup for a melt-up. Initially, that probably is seen as bullish, I think, although it hasn't happened today as we speak, right? Because if markets fell because inflation was too high, then if inflation's coming back in, right, and commodities are seemingly suggesting that, okay, then great. That should mean that stocks and bonds both rally just like how they both collapse. They both come back. The everything burst becomes an everything relief rally. At some point, though, you end up having a divergence.
Yeah.
Okay, where after the relief rally, if I'm right about this kind of melt-up setup, after the relief rally, you get back to stocks going down, but then hopefully treasuries acting as a safe asset, the risk-off asset, that's when you get that convexity. Treasuries outperform equities, classic risk-off, which again I need for ATAX, Roro, Jojo. And by the way, it's I've had a lot of people look at my funds and say, uh, why would anybody invest in something like this? Um, the best way to avoid a drawdowns after one's already taken place. This is not my opinion. This is fact with any asset class, any strategy. This has been a dislocation in the relationship of equities to treasuries, the relationship of risk on to risk off. It's not my opinion. This is fact. If you believe that the best thing to do is buy dislocations, well, then I'm not out of the game just yet.
Oh, yeah. Exactly.
Michael, what is the reason of this dislocation? Would you think, in your opinion?
It's really a question of why did it happen at the same time?
Yeah.
Right. It's like, why is it that equities and treasuries this? Because you could have a situation. You could have had a situation very clear, and that happened plenty of times in the 70s, where equities held or rallied while yields rose. Right.
Yeah.
The dislocation is the sequence. It's the way it happened week after week after week in terms of the same direction. Yields higher, bonds down, stocks down. Right. It's a good question. Some people are going to argue it's because of the high inflation. Again, I don't necessarily buy that. Look, the reality is the bond market has been in a bear market for longer than this year, right? Because yields were negative. Negative real rates were a thing for a long time.
Yeah.
Which is kind of interesting, because then you could argue that what happened this year is capitulation in that bear market, right? It's a different perspective on how to think about the bond market. But yeah, you can argue that bonds really have been terrible for a long time, and this is sort of your crescendo for that. Look, the reality is in any data set, you'll always have a degree of randomness. And that is not a very good response to investors, right? As somebody who's a fiduciary. But that's the reality. Any kind of quant work, you're always going to have some anomaly, some randomness that you cannot fully explain. And that's okay. But, I don't know what else to do when you're in the anomaly. You can't change an approach based on the anomaly.
Yeah, that's a very good point. I'm coming from an engineering background, that everything has to make sense for me. And this is really the first bear market that I cannot understand this anomaly. That why is not should work the way that it is working. And I like that. I like the fact that I know you're always believing in that the trading or investing is all about accepting the probability of the outcomes and the distribution of that probability. And that's a very, very interesting systematic approach to investing and trading, rather than just being result or reasons oriented.
Yeah.
No, and to the point, like you've seen me probably tweet that before. It's like amateurs look to the right of an equal sign. They look at the outcome. Pros look to the left, the variables, the process, the errors, right? And that's why it's like, I fail to understand how we got to a place in society where everyone just thinks you are good or bad based on the outcome, not based on the effort and what goes into the outcome.
Exactly. Well said.
Yeah, well said, Michael.
Yeah.
Michael, I have a question about the business cycles. I think there's a famous quote that you're well aware, that there is no gurus, only just the cycles.
Yeah, I love
like
that
we
quote.
remember last 2 years.
Smart guy who said that.
Yeah, that's my favorite. Oh, really?
Who said that?
Yeah, it was me, but it's like...
Yeah.
Oh, really?
Yeah, it's my favorite quote.
Oh, that's a favorite.
Michael,
Oh, I didn't know that it's actually you. This is amazing. And
Yeah, no,
we remember.
I came up with that. I came up with that when I saw all these glorifications of Kathy Wood. Nothing against Kathy Wood, but it's like when the media was making it seem like she's the financial services version of the Messiah. It's like, come on.
Yeah.
Yeah, I remember that when people were pouring on these unprofitable SPACs or the tokens, after memes, and it was going up, and everyone was thinking that they're geniuses. But now you're actually looking at that was just a cycle, and now, as you mentioned, if this bear market makes full of bears and bulls at the same time. And I love that. What do you think? What's your recommendation for the new traders, new investors that they're joining at the market now? I know obviously it's a very, very unusual condition. Do you have any recommendation for the new people to understand these cycles and survive them?
So first, like and subscribe to this channel, right, on YouTube. That's what I'll say. And also check out my channel on YouTube, Lead Lag Report. No, but in all seriousness, the only way you get better at anything, whether it's investing or anything, any domain, is spend the goddamn time. Educate. Right? It's like that old saying that it takes 10,000 hours to be good at anything. takes time, right, to be good at anything in life. It takes practice. It takes real self-reflection, real self-study, real hours. Not just looking at a goddamn chart, which unfortunately, I'm sorry to be as it's been a long day. It's wild to me that that's how people do their due diligence, and then people end up spending more time looking at cat videos than reading a prospectus, and looking at a balance sheet, and understanding a research study, a white paper, like I put out with these 5 different research studies that go into my own products as an entrepreneur. So it just takes time. There are no shortcuts in anything. And you know what? There are plenty of people that got lucky with shortcuts. They got lucky because they were in an environment where whatever they're trading and investing in, they got in at the right time and they made a whole boatload of money. And suddenly they think, to your point, they're geniuses. Okay, in any data set, there's anomalies. Same idea, right? The only way you ultimately, going back to mean reversion, the only way you end up having a higher mean than everybody else is humility, studying, spending the time, spending the hours, recognizing that you cannot control the future, you cannot control your outcome, but you can control your effort.
Yeah, that's the left side of the equation, the variables you're putting in, right? There's going to be some error term, but that's the variables you're putting in. Speaking of studying, again, as I mentioned, since we have over 900 people watching the show, I am a subscriber to the Lead Lag Report. I get tons of value out there. Andrew, if you could put it in the chat for our members to check it out as well. It's a rule-based approach. You add your commentary, a huge fan of that, and I discuss that again with our community as well. Try to look at things from a macro perspective, top-down approach, and really working your way down. I had a housing questions, and I really want to ask it since your lumber to gold ratio, and you're the lumber and the gold eye instead of the laser eyes. What are your thoughts on housing? I mean, a lot of things are. I do understand the supply side, and there's not a lot of inventory, and there's a lot of lack of capex in the housing market since '08, but just looking at price to rent ratios, there's tons of things that are really alarming red. So what are your thoughts? And I know you're not a fan of prediction, but would love your output.
Yeah, it's funny because some people say I'm not a fan of prediction, but I'm saying melt up. It's not about predictions, about conditions favoring an outcome, right? I just believe the conditions are there for some kind of rally. That doesn't mean I believe that's going to be the actual outcome, because I don't know until with hindsight. But let's talk about this for housing. First of all, I don't buy this narrative that that we're short homes, that we need more homes. It's like, again, ask further questions. So if you look at the number of homes that are estimated to be short, the estimate is that based on demographics, based on these longer term trends, there's about 3 million homes that need to be built across the U.S. Okay, I've seen estimates that are 1 million, some more. Let's go with 3 million. Okay. Well, the next question is, well, how many second homes are there? There's 10 million second homes. You got 3 million homes short, but you got 10 million second homes, which are not a primary residence. I look at that, I said to myself, is there really a shortage of homes? Or is this a function of all the easy money and speculation that caused people to buy second and third homes to then rent it out for Airbnb and Vrbo? Right, so when you start kind of digging a little bit deeper, higher rates or even lower rates, they're not going to change this dynamic of you need to build more homes, because if the homes are being taken off the market because they're not primary residences, it's all fake anyway, right?
Exactly.
So from that standpoint, this mortgage rate move is serious, and you're already starting to see, pretty big about face in housing demand. It seems to appear that way. You might have an initial kind of reverberation, but I still think there's a big headwind coming from housing. That's why I believe that you probably have lower lows in equity still to come, because housing is a big driver of the economy. It always has and likely always will be. I say likely because I don't know the future, right? But I do think that there is a real risk of what could be a severe decline in housing. And keep in mind, it's not just the U.S. This is a global phenomenon. COVID caused a lot of people to want to buy more homes, to have more space. You look at the Canadian housing market; it's absolutely stupid the way these prices have, and the unaffordability has gone. That doesn't mean you have to have a great financial crisis, because the dynamics are different from the housing peak in 2006. But to argue that housing is going to keep going up like this, I'm not saying it can't. It just seems like that's not the place to bet.
Yeah.
At 6% interest rate, the average pay for mortgage has been almost doubled, and that's a very, very scary number for a lot of households. A lot of households did not see such a pump in their mortgage payments.
Yeah.
And no, let alone any income that's countering that. Oh, and by the way, gas prices have now gone up. So you're talking about you're talking about a very, very severe decline in consumer discretionary spending power. Now, by the way, you look at consumer discretionary stocks relative to the S&P, they pretty much went back to pre-COVID levels, right? They undid all of their outperformance, relative to the S&P. So even internally in the market, there's a bet that consumer spending is going to do an aggressive about face, which, by the way, is deflationary.
Exactly. While we're on the topic of housing, I want to talk a little about rates. And we're seeing some of the prices. You talked about Canadian real estate, and like you got cap rates of 2% being normalized. And when you got 10-year giving you 3.5%, I don't know, who knows if 10-year continues to rise, then a lot of these investment models will fall apart. Michael, I wanted to kind of get your opinion. I'm personally.
Real quick, because actually, you actually sparked an idea, some thought. So one of the arguments about the reason the great financial crisis happened was because the models could not see an environment where housing declines that much.
Yeah.
Based on exactly what you just said, it's something I have to kind of think through a little bit. But I wonder if all these housing models ever anticipated a rate shock like this.
Exactly. Yeah, that's exactly what it was.
That's good. I mean, in Canada, we have something called a stress test. And now they're actually, the government forces mortgage lenders to do a stress test on the income of the household. And it used to be like 3%, and the mortgage rates were significantly lower. And now they're doing a stress test at 7.5 to 8%. Means that the borrower cannot, meet that criteria, then they cannot get the mortgage, even though their mortgage rates are still the 2-3%. But the stress, they increased the stress test on Canada. I'm not sure about the US, but at least they see a potential on default on some of the mortgages. At least the government sees that.
Yeah, just adding to that and the rates. I'm personally, Michael, I'm a huge fan of rates going up. We know, hey, like, be on the side of the savers, because we know economy is a double entry system. When there's more savings, there's going to be more investing. They have to balance each other out. What are your thoughts? I mean, we had 10 years of low rates. A lot of gurus were created, especially in Silicon Valley, the VC stocks. What do you think we're seeing a different trend of now we have to get normalize a 4%, 5% Fed's fund rate, or no, we're going to start easing again?
It's interesting. For all the talk about taxing the rich, the best way to close the wealth gap, at least in the margin, is to make the cost of capital have a cost.
Exactly.
No, really, because going back to your point about these tech entrepreneurs, it's like why is the wealth gap so wide? Because interest rates were pretty much just zero. So all the returns accumulated to those that could actually get the capital to borrow it and then play all these games with buybacks and all this stuff to enrich themselves. So if you really want to increase the balance or balance the wealth gap, right, and increase the power of the consumer, you've got to make the cost of money higher. Right? You'll do more to the wealth gap than taxing the wealthy if you just increase interest rates. So, and I would argue you need to do that even from a societal perspective, because while every system has some kind of wealth gap, you don't want it to be too wide before it creates, because if it gets too wide, it tends to create societal upheaval.
Yeah.
Right. So, I'm trying to make it more of an existential threat that if you don't have higher rates to close the wealth gap, it actually creates a real problem for the system. Right, from a protest perspective, from a happiness perspective. So yes, interest rates should be higher. There has to be a cost to capital. And by the way, that means there has to be bankruptcies. There has to be pain. You have to flush out all this bullshit that's happened to the economy over the last decade. Okay? That's not a very popular opinion. It's like everyone loves capitalism until they have losses. Right?
Yeah,
but you have to have losses.
Yeah.
Michael, it's not a political comment that I want to mention that, but I saw Jeremy Powell last week in the Congress talking with the Senate Finance, Housing, and even Senator Elizabeth Warren, she's far to the left, and she was really concerned about crashing the stock market and eventually making people out of the world. And she was pushing Jay Powell not to be too aggressive on increasing rates. And I couldn't believe that hear that from Senator Elizabeth Warren, which is far to the left of the spectrum in terms of controlling the corporations and Wall Street.
Yeah, it's like I've used that line before. I forget the exact number, but it's like, for all this talk about tax the rich, Congress, net worth of every single Congress member in aggregate is like 2 point something billion. Like, yeah, let's tax the rich. I'm down with that. Look, okay, so again, not to make it political, both parties suck. Okay, so I'll make it very clear on the political side, both Republicans and they both suck. Okay, so Republicans, they want to lower taxes. Trickle down economics hasn't proven to work, but by the way, they lower taxes and they still spend on military. So your debt keeps on going up under Republican administrations. Democrats come in, they say we want to tax, but we want to tax not to pay off prior liabilities, we want to tax to justify new spending. So neither party is ever making the debt lower. I mean, the perverse thing about raising taxes is that it actually increases national debt because it's used again as justification, right, for that. So I don't know. I look at this, I say to myself, both parties are doing the same horrendous mistake. They're leveraging the future, right? So I don't know what changes that. I don't know what stops that, other than, I don't even think it's about voting in new leaders, because nobody ever gets voted in for austerity. But the reality is, you can't fix the system until you fix that. Full stop.
Yeah, perfect. Thank you so much. I mean, we have almost 1,000 people right now watching. I think it's a record for our show, Michael. Yeah. Thank you so much for really promoting and coming into the show. Your name definitely carries a lot of weight. Adi, you want to go with the next question?
Yeah. So last question on the market, because I know your time is limited, and then we'll kind of wrap things up. By the way, again, I totally agree with you. Make equity premium mean something with the rates. What is there any systematic risk right now in the equity market that you're seeing? Any risk that kind of people are not seeing? Yeah.
So this is the thing. So I'm always a fan of Nassim Taleb's work of the Black Swan Anti-Fragile.
Yeah.
It is true that these 1 in 1,000 year crash events happen more frequently. Why? Because debt is so high. It always goes back to leverage. Why? Because if you have so much debt in the system, it doesn't take that many butterflies flapping their wings to create a hurricane, right? So the response by the Federal Reserve has always been, when there's a crash, re-leverage, which makes the debt load higher. Well, at some point, the debt load becomes so high that the 1 in 1,000 year event becomes like once a year, right? Because the more leverage you have in a chaotic system, the more fragile it is. So there is always a risk of a tail event. There's always a possibility that it becomes a lost decade. People forget that. People call the decade in the midst of the 2008 financial crisis as a lost decade because of what happened to Lehman. The lost decade happened because of 2 weeks, really, with Lehman Brothers, right? So it's about perspective. So my point is, yes, there's always risk, and all that means is that you have to diversify. Now, I know people are going to roll their eyes when I say that, because that's always the answer: diversify. Diversification doesn't mean having things that you like. Let me say it again. Diversification doesn't mean having investments that you like. Diversification means having investments that you hate.
Exactly.
Because if you hate the investment, no, really, because if you hate the investment, it means it's not working in that moment in time. Well, if it's not working, it's not correlated with everything else. Yeah. So if you're worried about risks, you better hate your damn portfolio, because that's the only way you're going to be surviving.
Yeah, exactly. I remember you tweeted, if there's not one name in your portfolio that is really pissing you off, you're not diversified enough.
How can you be?
Yeah, exactly.
Perfect. Thank you, Michael. I know you have a Spaces on Twitter, guys. For those of you who want to really follow Mike, follow him on Twitter. I'll put the link up there. And you're having almost, I think, weekly spaces that you're bringing a lot of amazing guests. I've been to some of them and I learned a lot. And I knew you're trying to bring Nassim into your space. I don't know if you have been successful to convince him to come or not, but I would be very interested.
Yeah, that would be an amazing. That would be an amazing show. If you can pull it off, that would be awesome. Yeah.
Yeah, I've been trying, but he's a challenging one.
Yeah, definitely. Well, Michael, thank you so much for your time. We really appreciate it. We broke the record. More than 1,000 people at some point were watching this show live. My last question is, and I've seen you do this, are we one of the few that understand this, or not yet?
You are among the exquisite few.
Exquisite of you. All right,
so much,
amazing. Well,
Michael.
thank you so much for your time. Really appreciate it. That was Michael Gadd, everyone. Thank you, Michael.
Thank you, Michael.
There you go. Appreciate it. Cheers. Thank you.
Have a good one. Cheers.
Thank you, everyone. Make sure to follow Michael and make sure to check out his website, Lilac Report. And I think that's it for us. See you all tomorrow morning in the chat, guys. Bye.
Yeah. Thanks, everyone. Thank you for the turnout. Really appreciate it. Have a good one, everyone. Thank you.